For Morningstar, I'm Jeremy Glazer. We recently launched a sustainability rating for funds, and I'm here today with John Hale. He's our head of sustainability research to talk about how the sustainability field has changed over the past few years and why individual investors should care about it. John, thanks for joining me.
Thank you.
So SRI funds, socially responsible funds, have been along for a long time, but now we're hearing more about ESG, sustainability. We're bringing out this new rating. How has the field really changed in the last couple of years?
Well, it's actually evolved quite a bit over the last couple of decades, really. You know, if we were sitting here in circa 1996 rather than 2016, we'd be talking about socially responsible investment funds, which primarily tried to kind of reflect the values of the underlying investor through primarily exclusionary screening of their portfolios. So, the classic were the sin stocks: tobacco, alcohol, gambling. And the whole idea was to kind of make the investor feel better about aligning his or her investments with their values. And a lot of it was institutional investors who wanted to align their portfolios with the mission, whether they were religious investors or something similar to that. Today, sustainable investing and what we call ESG is actually quite a lot different, although this sort of evolved from SRI. Today, when we talk about sustainable investing, we really mean talking about how to incorporate environmental, social, and governance issues into the investment process in order to focus on companies that are really doing better on those kinds of issues and therefore make good long-term investments.
So why should investors care about the sustainability, though, versus just being focused on total return and you just cutting the chips lie where they may?
Well, I mean, I think there's still a values-based component to it, and I think it's got a bit of a different character today than it might have had 10, 20 years ago, and that is that a lot of people are very concerned about sustainability issues. If you think about how they live their lives today in everyday life, recycling and trying to save energy and water and that sort of thing, and then as consumers, certainly a lot of consumers are trying to buy more sustainable products and support businesses that they perceive as having sustainable products and practices, and at the workplace, similar situation. So it's not that big of a jump, I think, from those spheres these days to the investment sphere. So an investor might want to do it because they want to have an impact with their money by allocating their capital to companies that are better sustainability performers. From a performance standpoint, there's a growing body of evidence that companies that perform well on sustainability issues can be very attractive long-term investments. So there's a connection to the performance side there. So really the idea here is that you can express your interest in sustainability and support for that, try to have an impact with your money, and you should fully expect to be able to receive competitive returns.
As this has grown in popularity, have you seen asset managers, fund companies really roll out more intended socially responsible funds, ESG funds?
Well, yes, we did last year see new fund launches around, I would say around 20 actually in the U.S., which is a pretty good number these days in the fund industry for new fund launches. But in addition to that, we see a lot of asset managers, what you call conventional asset managers, basically saying, you know what, intentionality aside, we agree that it is important to incorporate ESG considerations into our investment process. And so virtually every major asset manager out there is doing that in some way, shape, or form, even if it's just to better assess the risks and to create a more of a full evaluation of companies.
John, thanks for sharing your thoughts on sustainability today.
My pleasure.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.